Greetings, traders from all around the world. Thank you for joining me yet again. My name is Chris, and I am bringing you another Survival Guide episode. Today we're going to be covering the Relative Strength Index, so without further ado, let's switch on over and get on into it. The Relative Strength Index is one of the most popular technical analysis indicators out to date. When used correctly, it is a very powerful tool that gives traders a very serious edge over the market. It is something that has existed for quite some time, but has been time tested. It's my goal for all of you to understand a little bit more about the calculation that goes into the Relative Strength Index, but more importantly, some of the strategies that traders are using every day with the Relative Strength Index. At the end of all of this, I'm actually going to apply the RSI to some live charts so you can familiarize yourself with what it looks like as well. So be sure to stick around to the end. The Relative Strength Index, or RSI for short, was developed by J. Wells Wilder. It was first introduced in his seminal 1978 book, New Concepts in Technical Trading Systems, which is still a great book today. Wells Wilder was even singled out as the premier technical trader, publishing his work today by Forbes magazine in 1980 as a result of his commitment to creating cutting-edge tools and trading concepts such as the RSI. With a resume like that, anything that he produces is definitely worth taking a look at. The RSI is a momentum indicator that measures the magnitude of recent price changes to attempt to evaluate potentially overbought or oversold conditions in the price of an asset. The RSI is visually displayed as an oscillator, which we all know is just nothing more than a line graph where the line moves back and forth from two different extremes. The RSI can have a reading from 0 to 100. The RSI takes the speed and changes of price into consideration when doing its calculations. The math that goes into the RSI can be pretty daunting if you dig deep enough, but don't worry, we're going to simplify and we're not going to spend too much time on it. So the RSI is a relatively simple formula, but the in-depth explanation of the math of how those averages are generated can be tricky to explain without many pages of examples. Wilder's book, New Concepts in Technical Trading Systems, as we already mentioned, is an excellent book, and if you're very interested, I strongly recommend checking this book out as it explains all of it in great detail. Below, we can see the simplified formula, which is what we'll be using today. We have RSI equals 100 minus 100 over 1 plus the average of upward price change over the average of downward price change. When we word it like that, it's not too complicated. Next comes the how. So the RSI is considered to be overbought when it is above 70. And the RSI is considered to be oversold when it is below 30. So the two key numbers to remember with the RSI off the bat are just going to be 70 for being overbought and 30 when we're oversold. And as you see down here with this image I have provided, you'll see that it's not all that scary to look at either. Our top line here is marked off as 70 in the picture, and our bottom line here is marked off as 30. So as we watch the RSI oscillate towards the top line up here at 70, we're going to consider this overbought. And over here on the left, as we watch the RSI work its way down towards this 30 line, we're going to consider it oversold. Nothing too crazy going on there. Now we're going to work our way into some of the key workings that are going on behind the scenes with the RSI. So the RSI will often show chart patterns that may not be shown. They may not be shown on the underlying price chart, such as double tops, double bottoms, and trend lines. Support or resistance can also be displayed uniquely on the RSI as well. So, point is, the RSI can give us some insight into things that are occurring in the market that the simple price action in and of itself may not be displaying as of yet. In an uptrend or a bull market, it is common for the RSI to remain in the 40 to 90 range, with the 40 to 50 zone acting as a support area. Now, during a downtrend or a bear market, the RSI tends to stay between the 10 to 60 range, with the 50 to 60 zone acting as an area of resistance. Next comes the divergence. The divergence is one of the key strategies that traders are using with the RSI on a daily basis. So pay attention, because these are going to be some of the bread and butter secrets that traders out there are using. So if underlying prices make a new high or low that isn't confirmed by the RSI, this is a divergence, and this can signal a price reversal. So in order to understand what a divergence means relative to an RSI, we just need to focus on this top sentence up here. And I'm going to repeat it one more time. So if underlying prices make a new high or low that isn't confirmed by the RSI, this is a divergence that can signal a price reversal. So long story short, if we see the RSI going one way, but we see price going the other way, we have ourselves a divergence, and this absolutely can be used as some type of a trading signal. So if the RSI makes a lower high and then follows with a downside move below a previous low, then a top swing failure has occurred. If the RSI makes a higher low and then follows with an upside move above a previous high, then a bottom swing failure has occurred. Here we have an example of a traditional bullish divergence. So with the top chart, we have an example where the lows are progressively getting lower with the actual price. So price action is getting lower. And on top of noting that the lows are getting lower here, here, and here, we can also see that the highs are starting to get lower as well along the way down. Now, when we look down at the RSI during this same period of market data, that's not the case. With the RSI, we have the lows progressively getting higher over time, as you can see over here, as well as the highs progressively getting higher as well. So while one is coming down, the other is going up, and this is exactly what a divergence is. Next, we have an example of a bearish divergence, which is simply going to be a complete inverse of everything that we just saw. So instead of watching the prices go lower while the RSI goes higher, we're going to be looking for the prices to go higher while the RSI is going lower. And we actually have a few examples here to look at. So starting over here on the left, we can see that prices are going higher. We're seeing the lows get higher, and we're seeing the highs get higher. Now, during the same period of data, instead, with the RSI, we're actually seeing the highs get lower, and we're seeing the lows also get lower. So we have ourselves a divergence, and it's considered to be a bearish divergence because it's expected to cause bearish activity after this has occurred. Now in the middle, we have it yet again. So once again, we have our market getting higher, but the RSI is going lower. So another bearish divergence. And finally, on the right-hand side of the screen, we have one more scenario where once again, price is getting higher, but down here, the RSI is getting lower. So 3 solid bearish divergences there to choose from. The next type of strategy that comes to mind when thinking about RSI trading is going to be based around swing rejections. So the RSI can be used to provide what are called these swing rejection signals, and this is done by examining the RSI's behavior as it reemerges from overbought or oversold territory. The concept here is roughly comparable to price action breakout trading based on support or resistance level breaks. Starting off with a bullish swing rejection, we'll talk about what the rules are in order to find one of these and execute on it. So, rule number 1, the RSI needs to fall into oversold territory. Rule number 2, the RSI needs to cross back above the 30% mark. Rule number 3, the RSI forms another dip without, key word here folks, without crossing back into oversold territory. And then number 4, the RSI then breaks its most recent high. So number 4, the RSI breaks its most recent high. So you can already see some of the similarities in these rule sets that go into trading support and resistant breakouts as well. Here we have an example of a bullish swing rejection. Remember, with step number 1, we have to first fall below oversold territory, which we did. Then the RSI worked its way back above the oversold territory line of 30, as you can see by step number 2. And then by step number 3, we created a dip where we fell down and came back up without falling back below the oversold territory. And then finally, by step number 4, we broke the high that was created during the dip that survived not falling down into oversold territory. It sounds confusing, but if you are confused, don't worry. Just write the steps down and go over them one at a time, and it simplifies the entire process. Next is going to come our bearish swing rejection rules, and they are simply going to be the inverse, so this will be very easy to understand if you understood the first part. So step number 1 is going to be the RSI rises into overbought territory. Step number 2, the RSI is going to cross back below 70%. Step number 3, the RSI is going to form another high without crossing back into overbought territory. And then finally, for step number 4, the RSI then breaks its most recent low. So the RSI is going to break its most recent low. Once again, a complete inverse of our bullish scenario. Here's another example, but this time it'll be an example of a bearish swing rejection to make this a little bit clearer for those of you that are some of my visual learners. Step number 1, we are in overbought territory. Step number 2, we cross below that overbought territory, which is going to be the line of 70. Step number 3, we're going to create a swing up that does not allow us to go back into overbought territory. And then step number 4, we're going to break the low that was created during that swing. And at this point here, this is when we are looking for our entry. Just like the bullish scenario and very similar to standard support and resistance breakout trading. As with all things, there's some important reminders that we should cover before we jump on into RSI trading. So the RSI compares bullish and bearish price momentum and displays the results in an oscillator that can be placed beneath a price chart. Like most technical indicators, its signals are most reliable when they adhere to the long-term trend. This is the one aspect of this sentence I want everybody to focus on. When they adhere to the long-term trend, we generally see better results. Use the trend is your friend. Since the RSI displays momentum, it can stay overbought or oversold for a long time. When an asset has significant momentum in either direction, this is more prone to happen. So this means the RSI is most useful in an oscillating market where the asset price is alternating between bullish and bearish movements. So generally speaking, the RSI is going to provide us better trading opportunities in a market that is rotating back and forth. Continuing with our reminders, the traditional RSI overbought and oversold levels can be and should be adjusted if and when necessary to better fit the asset being assessed. For example, if a security is repeatedly reaching the overbought level of 70 due to a strong bull market, you may want to adjust this level to 80. Conversely, if the market is trending strongly downward, we may want to move the oversold level to a lower setting of 20 from 30. Some traders will apply a 50 midline to the RSI to better judge where peaks from either side are occurring during strong trends. It's also worth mentioning that a lot of platforms will already automatically have a 50 midline applied. Now let's go ahead and move on over to a live chart to show you how to apply the RSI to your charts and what it might look like so you're a little bit more familiar with it. Using the Finamark platform to apply the RSI, it's as easy as going up to our handy dandy Show Indicators Options button up here at the center, clicking that, and then coming over here, adding a new section on the right side, and going over here to the center again, and scrolling down to the R's where we're going to see Relative Strength Index, give that a click, and we are all set. Once I go back by clicking the Hide Indicator Options button, you're going to see that here the RSI is now at the bottom of my chart. Now, my personal preference, I do not like the RSI to be this large, so I'm going to go ahead and shrink it down a tad. I can gain the same information while still getting a broader view of the price action above as well. Now, as I scroll back through the chart, you're going to see a lot of scenarios where the RSI oscillated from oversold scenarios, like over here on the left, to overbought scenarios where it was actually above the 70 mark. And in the middle, I already have a 50 midline applied. The RSI is a lot of fun, and it's a very powerful tool, and now that you know some of the strong strategies out there that traders are using on a daily basis, I'm excited to see what you guys are able to make with it. Good luck, everybody, and happy trading. Thank you for joining me again, and as always, please click the like and subscribe button below to make sure that you get the most up-to-date information as I keep coming out with these for you guys.